Gold just came roaring back off the floor, and almost every explanation you are about to hear for it is wrong. If you own gold inside a 401k or an IRA, if you have been watching it grind lower and wondering whether you made a mistake, this stretch matters to you more than the number that brought you here does, because the number is the gauge. The gauge is the last thing to move. I am going to give you the honest read up front and then spend the rest of this proving it, because you did not click to be strung along. Start with this. In the worst weeks of 2008, when the financial system was genuinely coming apart, when banks that had stood since before your grandparents were born were being carried out on stretchers, gold went down. It got sold hard. Not because anybody stopped believing in it. It got sold precisely because it was one of the few things left in the world that a desperate seller could still sell at a real price. Hold that in your head, because it explains everything about what is happening to gold right now. Here's the major news, plainly. This advance is not being driven by panic. There is no crisis headline underneath it. What moved is the market's expectation of where interest rates go from here, and with it the dollar, which had been leaning on gold like a man leaning on a door. Softer labor data, a Fed that is under no pressure to tighten, a dollar coming off the boil, that is the engine. And that matters enormously because it tells you the thing almost nobody watching gold understands. The metal was never broken, the setting around it was, and gold is still, even after this run, meaningfully below its own record high. It is rallying hard, and it is nowhere near its high water mark. So the reveal in this video is not the move. The reveal is what the move exposes about the last several months, and about the job you actually hired this metal to do. There are 5 things sitting in plain sight here, and by the 5th one, you will understand why the professionals who move first are not talking about it on television. Before the first one, let me introduce you to the man I have been thinking about while writing this, because he is the reason I care about getting this right. His name is Earl. He is a retired tugboat engineer out of Mobile, Alabama. 31 years in engine rooms, pushing barge tows up the river and back down, standing watch in a steel box where the noise gets into your bones. Earl will tell you that in all those years, the gauge on the panel almost never told him anything first. He knew a bearing was going by, the change in the sound coming up through the deck plates. He knew a fuel injector was off by the smell in the exhaust. By the time a needle moved, whatever was wrong had been wrong for a while. The instrument lags the machine. Always. Earl has a rollover IRA now, built out of a lifetime of overtime and shift differentials, and a portion of it sits in gold. And for months he has been staring at the gauge and concluding the engine is broken. The engine was never broken. The first thing hiding in plain sight is that the force which knocked gold down was the same force now lifting it, and it has nothing to do with how much anybody trusts the dollar in the long run. Gold does not pay you anything, no coupon, no dividend, no interest. That is the whole design, and it means gold is priced against what you give up to hold it. When the market believes rates are heading higher and believes those rates will beat inflation, holding a metal that pays nothing gets expensive in the only way that matters. Money leaves. When that belief flips, when the labor market cools and the market starts pricing cuts instead of hikes, the cost of holding gold falls and money comes back. That is the mechanism. It is not sentiment and it is not mysticism. There is a second lever bolted to the first one, and it is the dollar. Gold is quoted in dollars everywhere on earth, so the dollar is the ruler you are measuring with. When the dollar strengthens, the ruler gets longer, and gold appears to shrink even if nothing about the metal changed. It also makes gold more expensive for every buyer outside the United States, which is most of the world's buyers, and demand thins out accordingly. When the dollar softens, both of those run the other way at once. Rates and the dollar are not 2 separate stories. They are one story told twice, and for months they were both pointed at gold's head. Now look at what happened earlier in this cycle. Conflict in the Middle East pushed oil and inflation risk higher. A reasonable person would assume that is bullish for gold. It was the opposite, and this is the part that broke so many holders' confidence. Because that inflation risk made the Fed more likely to stay hard, not less. Higher rate expectations, a stronger dollar, and gold got pressed down through a period when every headline said it should have been flying. Holders like Earl watched war on the news and watched their metal sag, and quietly concluded that the whole thesis was a lie somebody sold them. The machine was doing exactly what the machine does. Gold trades the expected path of real returns, and for that stretch, the expected path went the wrong way. Then the data softened. The labor picture came in weaker than the market was set up for. Inflation prints came in without a nasty surprise in them. Suddenly, the Fed is not the enemy anymore. The dollar loses its support, yields ease, and gold puts in its strongest run in a long while after a long grinding slide of losing months. Same metal, same vaults, same everything. The setting changed. And here is why I am telling you this, rather than just cheering the price. If you did not understand the mechanism, you experience the decline as a betrayal, and you will experience this recovery as luck. Both readings will cost you money, because both of them leave you reacting to the gauge instead of listening to the engine. And that gets much more expensive when the second thing comes into play, which it will. The second thing is the one almost nobody says out loud, and it is the difference between the two jobs gold does. Go back to the fall of 2008. The financial system is seizing up. Credit markets stop functioning. Institutions that everyone assumed were permanent are getting rescued or buried over weekends. If gold is the panic asset, that is gold's moment, and gold should have gone vertical. Gold went down, hard. Deep into the wreckage, gold was sold off, along with everything else, and plenty of people who had bought it exactly for that scenario watched it fail them in real time and swore off the whole idea. Why did it happen? Because a hedge fund facing redemptions and a margin call does not get to sell what it wants to sell. It sells what it can sell. Its private equity stake will not move. Its distressed credit book has no bid at all. Its real estate is frozen solid. But gold has a deep, liquid global market that works at 3 a.m. in a hurricane. So gold gets sold, not because it failed, but because it worked. It was the good leg, and the funds cut it off to stay standing. Think about who is actually pressing the sell button in that moment. It is not a person with a view on monetary history. It is a portfolio manager with a redemption notice on his desk and a clerk on the phone telling him what has to be wired by the close. He is not selling gold. He is raising cash, and gold happens to be the only thing in the building that will convert into cash inside the hour at a price anybody would call fair. That order hits the market as selling pressure and prints on the tape as gold going down, and a retiree watching from his kitchen reads it as a judgment on gold. None of it was a judgment on gold. It was that fund confessing what the rest of its book had quietly become, which was unsellable at any price. And then what happened? Once the forced selling burned itself out, once the world moved from the liquidity problem to the solvency problem, from I need cash right now to what is any of this paper actually worth? Gold went on to roughly triple over the years that followed. The people who sold gold in the panic were right about needing cash and catastrophically wrong about everything after. I know how that sounds. The safe haven asset got dumped in the middle of the worst financial panic in living memory, and then tripled. If you think I am dressing that up, do not take my word for a syllable of it. The World Gold Council publishes the full historical price record, and the fund flow data behind it free on its own website. Pull up the gold price through the back half of 2008 and then across the years after. It is all right there in the public record. Check me. Because that is the distinction that decides how you should feel about your own position. A liquidity haven and a solvency haven are two different jobs. A liquidity haven is what you sell when you need cash immediately. A solvency haven is what you own when the question stops being, can I get cash, and becomes, is the cash worth anything, and is the institution holding my claim actually good for it? Gold is the only asset most families can own that does both jobs, and the two jobs pull in opposite directions in the short run. When the world needs liquidity, gold gets sold. When the world questions solvency, nothing else does the work. Earl, standing in his kitchen in Mobile, looking at his statement, thinks he owns a fear asset and that the fear asset let him down. He owns an insurance policy against a claim that has not been filed yet. Those are not the same thing, and confusing them is what shakes good people out at the exact wrong moment. Every big drawdown gold has ever had has been a liquidity event or a rate event. Every generational run it has ever had came after one. That pattern has not changed in my years around this metal. It changed nothing this cycle either. And that brings us to the third thing, which is where you find out why none of this comes out of the mouths of the people paid to explain markets to you. The third thing is that there are two gold prices, and you have only ever been shown one of them. There is the paper price. That is the number on the ticker, and it is set on futures exchanges and in over-the-counter dealing rooms by contracts, algorithms, positioning, and margin rules. Almost none of it involves anybody taking delivery of anything. That price can move in seconds, and it moves for reasons that have nothing to do with metal. A margin requirement gets raised and borrowed positions are forced out. A crowded trade unwinds. A model flips a signal. The paper price overshoots in both directions because that is what a market running on borrowed money does. Then there is the physical price. That is what a buyer actually pays to take real metal into real hands. That price is stickier. It cannot be pushed around by a keystroke because at the end of it somebody has to produce bars and somebody has to move them and somebody has to store them. Understand what the futures exchange actually is, because the name confuses people. It is a market for contracts, with the metal bolted on at the back as a formality. The overwhelming majority of those contracts are closed out for cash before anybody ever has to deliver anything, and the whole structure works beautifully on the assumption that they always will be. Everyone rolls, nobody stands for delivery, and the machinery hums. The metal in the warehouse is not there to satisfy the contracts. It is there to satisfy the small fraction of contracts that ever ask. That assumption is what sets the price you see quoted as the price of gold. And it is a fine assumption, right up until enough holders decide they would rather have the bar than the settlement. Most of the time, these two prices live close together, and nobody needs to think about it. But they can disagree, and when they do, the disagreement shows up in ways you can watch. Premiums over spot widening at dealers, lease rates spiking, the market for immediate metal pricing above the market for later delivery. That is a market telling you that the thing and the claim on the thing have come apart. Earl understands this better than most people with finance degrees, and he did not learn it from a book. On a towboat, the paperwork says the barge is loaded to a certain draft and the manifest says what is in it. The river does not care what the manifest says. What matters is what the hull is actually carrying when you push it into a bend with a current running. He spent a career on the difference between the document and the cargo. And when they come apart, the paper price is the one that eventually has to reconcile. The metal cannot move to meet the paper. The paper has to move to meet the metal. That is exactly what the last several months looked like from where I sit. The screen said one thing while the people who buy metal to keep it kept buying it. And on a financial news channel, there is no way to make that into a segment. There is no ticker for it. Nobody gets to put a chart up and say the claim and the thing are drifting apart, come back in 18 months. So they report the paper price, call it gold, and move on to the next block. Which is exactly why I want to say this to you here, because it is the practical question underneath everything I have told you so far. If the paper side is the fragile side, then the honest question for a retiree is which side of that line your own money is on. A futures contract, an ETF share, an unallocated balance at a bank. All of those are claims. They are somebody's promise. And you should know that gold has now overtaken the euro to become the second largest reserve asset held by central banks on earth, sitting above the euro on their own books. The institutions that could hold literally anything they wanted, that could park their national savings in any currency or any government bond in the world, chose the thing that sits in their own vault and cannot be switched off by somebody else's decision. You can make the same move they made inside the retirement account you already have. That is what our free retirement wealth protection guide walks you through, step by step, in plain English, how an American retiree can diversify a portion of a 401k or an IRA into physical gold and silver held in your name without triggering taxes or penalties and without having to become an expert in any of it. This is not for insiders, and it never was. If you have $100,000 or more in any retirement account, this was written for you. If you are watching this on your TV, just scan the QR code on your screen. If you are on your phone or your computer, go to shieldmysavings.com. It is free from our family to yours, no obligation, and there is nothing to buy. Now hold on to that idea about who is buying and who is selling, because the fourth thing is about to turn it on its head. The fourth thing is that the money already came back quietly before the headlines did, and the way it came back tells you where in the cycle you actually are. Here's what happened while the tape was ugly. Gold-backed funds around the world had been bleeding money for a stretch, month after month of outflows, and then that flipped. Money came back in, and it came back in across every region at once, with Europe leading the way and Asia adding to it. That is a broad turn in behavior, far wider than one desk making one call. Pay attention to the geography of it, because that is the part with information in it. The heaviest buying came out of Europe, with British and Swiss funds leading, and Asia adding on top. Those are three separate pools of money on three different clocks, answering to three different sets of clients, and they move the same direction at the same time without coordinating anything. When money that does not talk to itself starts behaving identically, it usually means the same arithmetic landed on all of their desks at once. That is what a change in the rate outlook does. It reprices gold in every currency simultaneously. But here's the part that I find far more interesting, and it is the opposite of what a promoter would tell you. Positioning through all of this has been described as close to neutral. Total assets in those funds ticked up modestly, not violently. Nobody is euphoric. There are no lines at coin shops, no cab drivers with opinions on bullion, no relatives calling you for tips. This is dip buying, not mania. Sit with that, because it is genuinely good news for you, and it is the sort of thing that gets left out. Manias are how tops are made. What you are looking at is the early, unglamorous phase, where money returns because the math changed, not because the crowd showed up. Gold made its record high, then fell hard, based out, and is now climbing back, with the crowd still absent and the metal still well below where it once traded. Look at the shape of that, because the shape is the tell. A speculative bubble that pops does not base out and recover, with money coming back in across three continents, while positioning stays neutral. It bleeds, and it keeps bleeding, and each attempt to rally gets sold by people desperate to get out at whatever they can. That is not the picture in front of you. What you have is an asset that got repriced by a change in the rate outlook, sat at the lower level long enough for the sellers to finish, and then turned when the rate outlook turned back. That is a repricing running its course, and the same arithmetic that took it down is now working the other way, which means the honest question is no longer about the market. It is about you. And there are three of you watching this, so let me talk to each one. If you are holding gold at a profit, your fear is giving it back. You have watched a gain appear, and you remember how it felt when the last one evaporated, and every day it goes up, the urge to lock something in gets louder. Understand what that urge really is. It is the reflex of a trader, and you are not a trader. You did not buy this to catch a swing. You bought it to be the part of your savings that does not depend on anybody else's promise. If your gold has grown into a share of your money you would not have chosen on purpose, then rebalancing is a legitimate, unemotional decision. But selling out of a position because it went up, and then hoping to buy it back cheaper, is how people end up owning nothing at all through the years that mattered. If you are holding gold underwater, bought closer to the peak, watching a red number and feeling foolish, this one is personal. The temptation is to sell and make the pain stop, and I want you to see clearly what that does. A paper loss is a number. Selling converts it into a permanent, realized, unrecoverable fact. Ask yourself one question and answer it honestly. Has the reason you bought this changed? Not the price, the reason. If the debt is bigger, the deficits are wider, the political pressure on the central bank is heavier, and the world's official institutions keep accumulating the metal, then nothing about your reason has changed. Only the gauge moved. Earl's engine is running fine. And if you have not bought any yet, your fear is the opposite. You are afraid you missed it, and simultaneously afraid you are stepping in front of a falling knife. Both at once, which is why you keep not deciding. So drop the question of whether this is the perfect entry, because nobody can answer it, including me. Ask instead what share of your retirement you want sitting outside the paper system entirely. That is a question about structure, and you can answer it without predicting anything. And it is far more comfortable to answer while the crowd is absent than after they arrive. Now, having said all that, I owe you the other side, and I would rather you hear it from me than find it later and wonder what else I skipped. Let me be straight with you about the strongest case against everything I have just laid out. Gold's advance here rests on an expectation, and expectations get revised. The market has decided the Fed is heading toward easier policy. If inflation reaccelerates, if energy spikes again, if the labor market comes back hot, that entire rate cut expectation can be repriced in a matter of sessions, the dollar can firm right back up, and the exact mechanism I described as Gold's engine will run in reverse. That is not a hypothetical. That is precisely what happened earlier in this cycle, and it took gold down substantially from its record. Anybody who tells you the metal only goes up from here is selling you something. The second half of that case is just as fair. Gold pays you nothing. If real yields go durably positive and stay there, gold can underperform for years. That is not a theory either. It happened after 1980 when Volcker took rates to levels that made cash genuinely attractive, and gold went nowhere for 2 decades. A retiree who put everything into it at the wrong moment in that era waited a very long time to be right. So what do I not know? I do not know where the price goes in the next stretch of sessions, and I am not going to insult you by pretending I do. I do not know whether the Fed follows through on what the market has priced. I do not know whether this rally runs at the record or stalls well beneath it. Here is what I do know, and it is why I still hold the view. The reason to own gold was never the next move in the price. It was the shape of the balance sheet underneath your entire retirement. The debt that has to be refinanced, the political pressure on the institution setting the price of money, the growing number of governments that decided a reserve which lives in somebody else's system is a reserve that can be switched off. None of that resolves in a quarter. All of it is still on the table. That is the solvency question, and this rally is not being driven by it, which means the job you actually bought this metal to do has not even been called on yet. And that is the recognition I want you to sit with before I let you go. Look at who moved first. The central banks did not wait for a headline. They spent years accumulating, adding to their own vaults on their own schedule, straight through periods when the price was falling and the coverage was mocking them. Gold passed the euro in the world's reserves while the financial press was busy with something else. The official sector was not reacting to the news. The official sector was the news, and almost nobody covered it as such. Meanwhile, the ordinary retiree gets informed at the very end. The pension consultants have not rewritten their models. The mainstream allocation advice still treats a metal that has been money for 5,000 years as a curiosity worth a rounding error. By the time this is the consensus, by the time your advisor brings it up unprompted and it leads the evening business segment, the repricing will have happened without you. None of that requires a conspiracy. It is just how information moves through a system where nobody gets paid to tell you early. So what does a calm holder actually do with all this? A few principles, and they are principles, not instructions, because I do not know your situation, and anyone who claims to from a video is lying to you. Size it so that no shakeout can ever force you to sell. Forced selling is what destroyed the people in 2008, not the price itself. Own the metal rather than a promise about the metal, so that when the paper side and the physical side disagree, you are on the side that does not need anybody's permission. Do not sell into a bottom because the pain got loud. Keep the share of your savings you may actually need to spend in the next few years somewhere boring and liquid so that the metal never has to be the thing you reach for in an emergency, because the whole point of it is that it does not get liquidated on somebody else's schedule, and know which job you bought it for. If you own it expecting it to jump every time a frightening headline crosses the wire, it will disappoint you regularly, and you will sell it in frustration long before it ever gets to do the work you actually hired it for. And decide what you want your ownership to look like now, while nothing feels urgent, rather than in the middle of the week, when everything does. That is the honest why now, and it has nothing to do with a deadline. The window where a decision like this is cheap, unhurried, and completely reversible is exactly the window where it does not feel necessary. The moment it feels necessary, the terms will have changed. If you want to understand how this actually works, get the free Retirement Wealth Protection Guide. It lays out how American families move a portion of a 401k or an IRA into physical gold and silver held in your own name inside the account you already have, without taxes and without penalties. And think about it for a moment in terms of what you leave behind, because I suspect that is the real reason you are still watching. Everything Earl built came out of 31 years of engine rooms and time away from his family. What his kids and his grandkids inherit will be whatever is left standing after every currency decision made between now and then. Metal held in your own name is one of the few things in an estate that does not depend on an institution still being solvent and still honoring a promise decades from now. And if you have $100,000 or more in your retirement accounts, watch this all the way through and mention that you did, and we will set you up with a free one-on-one educational web conference. A real conversation about your situation, your accounts, and your timeline. Nothing is sold on it. If you are watching on your TV, scan the QR code on the screen. If you are on your phone or your computer, go to shieldmysavings.com. From our family to yours, no obligation, nothing to buy. Earl called me after he finally understood the difference between the two jobs. He said the thing that got him was the engine room. He said he spent 3 decades teaching young deckhands that the panel is a summary written after the fact, and that anybody who runs a boat off the gauges alone will eventually run her aground in perfectly calm water. Then he laughed and said he had been doing exactly that with his own retirement for months. So stop reading the needle. Listen to what is coming up through the deck plates. The sound changed a long time before the gauge did, and the gauge is only now catching up.